What's the Risk? Hosted by myself, Daniel Crowe, and Peter Mancell, founder of Mancell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on the historic returns of various ASX 300, MSCI World ex-Australia splits. Obviously, we know these indices are tracked by Vanguard's ETFs, VAS and VGS, and are known as the VAS VGS split, a popular construction with DIY investors. We're looking at 30-70, 40-60, 50-50, 60-40, and 70-30 across each construction, and they are rebalanced annually since 1980. Your Investment Philosophy book we wrote, shameless plug, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational, not rendering financial advice. Don't make a step to sign. These are simple concepts we like investors to better understand risk so they can make informed decisions. So I had a question from a viewer asking about this, and when I looked into it, I was surprised at how close the long-term returns were, so I thought it'd be worth looking at, as it might surprise some people as well. As you can see, recent years, we know global stocks have dominated, but you go back further and the impact of the last decade in the US dragged down longer-term returns there. But since inception, 50-51. So obviously this is period dependent, and at the end of 2024, it probably won't look the same, but over the longest time period, we have the middle of the road option was the winner.
I'd love to make 2 points in relation to this slide, Daniel, and I'm going to focus specifically on the since inception data. No matter which of the 5 blends that an investor might put together, and assuming that they choose to remain disciplined to that belief, the end result is so close to the same, you just can't say that one is better than the other. The difference between 11.15 and 11.10, highest to lowest, that's just rounding error. It's nothing more than that. And secondly, if you think about diversifying away from Australia to a globally diversified equity portfolio, you probably should have a portfolio that's 96 or 97% global stocks and 3 to 4% Australian stocks, because Australia only represents a bit over 3% of the global stock market. So to say that you're going to take a 30% Australian position, or a 40 or a 50 or a 60 or a 70, you're taking a heck of a bet on our market relative to the rest of the world, over and above what the rest of the world thinks our market's worth. The other point that I'd make is that these returns almost certainly don't take into account franking credits. And if you do take into account franking credits, it'll probably just improve the results of the portfolios with a higher bias towards Australian stocks. So you might find that the difference between the 50-50 and the 70-30 Australian weighted portfolios might be almost zero. I think that the final point I'd make here is, if an investor takes a stance with the local versus global allocations, if they can just stick with it, they'll actually get a good result. If they start trying to predict when it's better to have more in Australia, when it's better to have more globally, and that's pretty topical at the moment with Trump just having been elected and being really pro-US in his rhetoric before the election, investors might start thinking, oh, well, should I be changing my weightings? I would say to them, try as hard as you can not to. Discipline pays off.
Yeah, there was an article in the AFR recently. I think it might have been from Vanguard, I'm not sure, but they're making the point that more and more Australian investors are going further and further into international stocks. I'm guessing it's probably due to this performance that we're seeing on the screen.
And look, I think it's fair to say the majority of Australian investors' stock market investing is substantially through their superannuation accounts. There has been a significant shift towards global stocks away from local over the last 20 odd years. Even our own model portfolios currently sit at 40% Australian, 60% global for tax-paying investors. And it wasn't that long ago that was at 50-50. Our reasoning for that is more along the lines of the point I made earlier about Australia being such a small part of the global market more broadly. But secondly, 40, 50 years ago, you might have said Australia was an emerging economy, but now we have to say Australia is a truly developed economy. And as a result, it doesn't benefit from an emerging market type premium.
So this is broken down by decade, and you can see the influence of global stocks, and there's been a 1 to 2% premium if you tilted globally versus locally in 3 out of the 4 decades. But the real drag was in the 2000s when MSCI World ex-Australia was down 30.82% for the decade.
You've got a situation where there's a minus 5% result between the 70-30 and the 30-70 in the 2000s. And there's a minus 1% for each of the next 10 years on average and a minus 2% thereafter. You add those things together and it's all but the same.
And you might hear occasionally some people say something like, well, what if the 2000s wasn't there? But at the end of the day, it is. So you really have to take it into account anyway.
Absolutely. You can't dismiss a decade like the 2000s and say, well, that's not representative. It's absolutely representative. You can't just take out a bad period out of a data series and say, well, if we ignore that, then this is the outcome. That's the sort of logic that someone will make that thinks they can predict markets. Well, I wish them the best of luck if they think that.
Growth of wealth, as we already know, they're all very similar. But if you note the white line leading into the 2000s, then trailing coming out of it, that's the 70% bias to MSCI World.
Every one of those portfolios is a great portfolio. There are times where each one wins. There are times when each one loses. You've only got to look at, as you said, the year 2000, where white's at the top. By 2007, bottom, the positions randomly change over 44 odd years. The secret there is the investor that stays disciplined gets a good result. Those that try to time when to change between them are the ones that place themselves at the greatest risk, because the timing of the changes is guesswork, because nobody knows what the remainder of the chart's going to look like.
Best and worst 1 year return. All the worsts are similar in start dates, just a case of how much.
I would just ignore the 1 year results no matter what, but you can see there, sure, the difference between the 30-70 to the 60-40 over 1 year, that's a 15% difference. So the investor got lucky. Obviously, global stocks hit it out of the park from the year September 1986. But when you put it in context and then you go back and look at the 30-year charts, the variations are so insignificant. Just pick one and stay disciplined.
Vision Frontier, all very similar, grouped in the same area. And the most volatile are actually the ones that are biased towards the ASX.
Yep. Again, I look at this and it just says, pick one, stay disciplined. You'll get the rewards you deserve. You just need to give it time.
I think that's the major message to come out of this.
Well, you look at all of those coloured dots and you go, okay, average returns about 11%. Standard deviations range from 12.5 to 14, which means 96% of your returns are going to finish between sort of minus 14 and positive 39. That's the way it's going to be. 4% of your returns will be outside that range or something close to that. There's so little difference between them. It's just not worth taking notice of.
And sources and descriptions of data. Thanks for your time.
Okay. Thanks, everyone.